Are traditional expert calls in the investment world becoming obsolete? According to Stream, they are, and you can access primary research easily and efficiently through their platform. With Stream, you'll have the right insights at your fingertips to make the best investment decisions. They offer a vast library of over 26,000 expert transcripts powered by AI search technology. Plus, they provide competitive rates on expert call services, and you can even have an experienced buy-side analyst conduct the calls for you. But that's not all. Stream also provides the ability to engage with experts one-on-one and get your calls transcribed free of charge, all for 40% less than you would pay for 20 calls in a traditional expert network model. So if you're looking to optimize your research process and increase ROI on investment research spend, Stream has the solution for you. Head over to their website at streamrg.com to learn more. Thanks for listening, and we'll catch you next time. Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could rate, subscribe, review wherever you're watching or listening to it. With me today, I'm happy to have on for a follow-up podcast, my friend, AJ Secrist. AJ, how's it going?
I'm good, Andrew. Thanks for having me.
Thanks for coming back on. We'll talk in a second about why you're coming back on, but before we get there, just quick disclaimer, nothing on this podcast is investing advice. That's always true. Everyone should consult a financial advisor, do their own due diligence. This isn't financial advice. That out the way, the stock we're going to talk about is in December, you came on and did a pitch on Lamb Weston. The ticker is LW. Stock did swimmingly right after that podcast. You know, I think it went from it was probably low 80s when we talked at the time.
Yeah, something like that, yeah.
Yeah, and it went up to about 120, and then over the past couple of weeks, they reported kind of soft. It was their fiscal Q4 23 earnings, and the stock has come back to mid-90s, where, you know, it's still up pretty nicely since when we talked about it, but I know you've been saying, hey, like, this is a great business. It's pretty much firing, and I know you wanted to come on and talk about it because it's still a top idea for you, and you want to talk about the softness and the opportunity. So I'll pause there. What's going on with LW right now?
Yeah, well, I mean, it's frustrating. It's been frustrating, right? They came out in July. This was their year ends May 31st. So this was their Q4 earnings plus guide for the upcoming fiscal year. So fiscal 24. And they beat estimates as I had hoped. They came out with guidance ahead of street as I had hoped. And the stock, I think, was up like 3 pre-market, ended up down 7 that day. I think down 3 the following day. And for like the last month, it feels like it's been down 1 or 2% every single day. And it's just bled. So it's been tough, especially in the wake of a beat and raise. I think the reasons for the stock getting sort of mauled after a beat and raise. I mean, I've heard a lot about positioning. That's hard for me to quantify. I have no idea.
It's not enough of an AI play. You know, they didn't come on and say, hey, we're using AI to make better French fries, so they can't go up.
Yeah. I mean, I should talk to the board about that. I've heard positioning used as a rationale. I don't know. I have no idea how you quantify something like that. But I think the fundamental issues were volumes were ugly, right? It was a big beat and raise on the back of price, and volumes were down, abruptly down across several area segments. You know, in the big global QSR segment, volumes were down 11, and this was after a series of quarters where it was basically plus or minus low single digits. So all of a sudden, it took a steep dive. The food service business was down 9, and that was against a -3 comp, so down 12 on a 2-year stack. Retail is down 10 against a -2 comp, so it's down like 12 on a 2-year stack. And so I think the market, the market has real concerns here, right? Have they pushed price too far? Have they found the limit to their pricing power? Are customers pushing back? Are competitors getting more aggressive on price? And are we going to compete away the margins that the industry has made progress on over the past several years? So I think those are the fundamental issues. I mean, apart from that, we had a big increase in the CapEx guide. They're building 4 plants simultaneously at the moment, so you'd sort of expect that, but management doesn't really help you figure out what spend is attributable to what plant and when that's going to roll off. More importantly, they also had a big sort of step up in SG&A. And they don't really help you figure out, if and when that's going to roll off. And really, I think ultimately the biggest fear is just, Lamb is losing volumes, and the industry, not only Lamb but everybody else, is bringing on supply as well over the next couple of years. And so the real, nightmare scenario is, industry demand is falling through the floor at the same time as everybody's bringing on new supply. And then you can dream up a scenario where you've got lots and lots of excess capacity, and pricing and margins really get involved, right? So that's I think the real fear in the market. And obviously, I still own the stock. I still like it. I'm pretty comfortable with all of those.
Let me so I want to do two questions that were kind of in the quarter, but are broader trend questions. Then I want to do like kind of a thesis update question. So one of the questions was, somebody came on in the call and said, hey, you guys have been pitching for years. French fry attach rate went up during kind of COVID, right? And probably because everybody was inside, so nobody cared about what they look like, and we were all looking for comfort food and everything. So you guys have been pitching for the past several years. French fry attach rate has gone up, but now we've seen one quarter. This was the first quarter of demand drop. And I think it's an obvious question is, hey, as the world, like we're pandemic now, right? As we're demic at this point, does French fry attach rate normalize, in a not disaster scenario, but does it normalize back to where it was pre-pandemic, or does it come somewhere in between? Basically, are we going to see French fry attach rates decrease? And then that would play into everything you're saying where, hey, it's really bad for an industry when you're seeing demand decrease right as supply is coming online.
Yeah, no, I meno, it's funny. They talk about the fry attach rate, but they don't give you any numbers. There's no public index. There's no data. Like, what is this? Like, I have never seen any data around the so-called fry attach rate. And they keep, I wish they would stop talking about it, honestly. But I have no ability to assess that. What I do, what I can assess is, number one, the rationale that they provided on the call makes it's at least plausible. And number two, global demand still looks good. The private competitors are still seeing volume growth. The biggest competitor is seeing high single-digit volume growth. So we can at least say that demand isn't falling through the floor across the industry. So the so-called fry attach rate must be okay.
I do understand the fry attach rate matters, right? Like McDonald's moves, if McDonald's takes the fry attach rate from 69 to 69.5%, like it's going to move hundreds and hundreds of thousands of tons of potatoes. But I'm with you. It seems like a weird thing to focus on. If it matters for your models, I was in Montreal last weekend and I ate more poutine than I think any humans eaten in history. So you can build that into your models if you want to. But now I'm trying to cut back on fries. So I don't know. It might be a wash.
Well, thank you.
Let me ask a slightly different question. One thing that just jumped out to me as strange is on the call, they talked about French fry attach rate, but they also mentioned something about their customers having inventory destocks and drawing down on inventories. And look, I understand like everything with it is supply chain has inventory, but it just like broke my mental model a little bit that LW would have their customers saying, oh, actually we're oversupplied. We need to draw down. Cause like I've got a bowl of potatoes in my kitchen that if I'm oversupplied on potatoes, right, they start like sprouting the little bumps, and then the potatoes got the door. So the oversupply goes away real quickly. And I understand a lot of this is frozen potatoes, but I was kind of surprised by that in like a fast moving industry where the turn should be pretty high and it's a food product.
But remember, these things are frozen.
Yeah.
Right? There's a pretty long shelf life on these things. And the potatoes, think about the processing cycle, right? You're going to harvest potatoes in July, August, September, October, that you'll be processing for the next 12 months. So, the potatoes are frozen. They could be processed 12 months later. And then the fries themselves are frozen as well. So the shelf life is longer than you would think. And, I ran around chatting with folks in the industry just to say, like, does this actually make sense? The rationale, the reasons for the volume declines on the call, I think were, one, inventory destocking. Folks have said, that's a reasonable explanation. They've seen it because of all the supply chain issues. People were over. Okay, fine. It's at least plausible. I don't know how much or who. Well, I understand it was in Asia, but it's at least plausible. Number two was what was the other issue? Well, they had a private label customer, a big one based in Arkansas, that is dropping their existing private label supplier and bringing Lamb back on as a private label supplier. And they are basically just trying to burn down the private label incumbent and making room for Lamb. And Lamb just had a more aggressive supply schedule than they did. So that was another issue. They talked about QSR traffic and casual dining traffic, and that was that's sort of mixed, right? Casual dining traffic was certainly down low singles, and it was offset by QSR traffic. So that's fine. I mean, you can actually test that. You can see that. You would rather, from Lamb's perspective, you'd rather have the traffic in food service than QSR because it's higher margin, but at least demand is still there. I think their rationale is at least credible. And I think the most important point is that, Lamb and, McCain and Simplot are still seeing volume growth. And so they're actively taking share from these guys. That is sort of normal, sort of ordinary course market share jockeying for different contracts. If you have capacity at a plant that's better positioned than somebody else, you can take that business without gutting price.
No, that all makes total sense. To me, it's just one of those things like, look, I'm willing to accept like business is messy and sometimes it all doesn't happen in a quarter. But you and I were emailing a little bit about my post on Sinclair over the weekend. And, it's once management says something to me where it raised a red flag to me, or kind of raised the hairs on the back of that, because it didn't fit with how I understood like food service and inventory and stuff, where they say, hey, our customers drew down inventory so much. And if it's true, that's fine. But, if they're kind of pulling one over your eyes, I'm like, ooh, that's where the big red flags come in. But I think that's completely credible. And now a quick word from our sponsor. Are traditional expert calls in the investment world becoming obsolete? According to Stream, they are, and you can access primary research easily and efficiently through their platform. With Stream, you'll have the right insights at your fingertips to make the best investment decisions. They offer a vast library of over 26,000 expert transcripts powered by AI search technology. Plus, they provide competitive rates on expert call services, and you can even have an experienced buy-side analyst conduct the calls for you. But that's not all. Stream also provides the ability to engage with experts one-on-one and get your calls transcribed free of charge, all for 40% less than you would pay for 20 calls in a traditional expert network model. So if you're looking to optimize your research process and increase ROI on investment research spend, Stream has the solution for you. Head over to their website at streamrg.com to learn more. Thanks for listening, and we'll catch you next time. Let's back up a second. So when I reviewed the last podcast, and I should have mentioned this earlier, I'll include a link to the podcast we did in December that went over kind of the full Lamb thesis. And I think that podcast actually holds up really well. And we talked a lot about other like longer term issues like, hey, what if Andrew does give up carbs for a while and, the whole nation joins him? And how would like potato demand do with that? And I think we answered potato demand like the American eater always wins. But at the time, if I was simply summing up your thesis, you said, hey, this is an $80 stock. I think the right multiple for this is kind of in the 20 to 24 range, so call it 22. And I think we've got line of sight to this business doing $7 per share in earnings. And so slap a 22 multiple on $7 per share earnings, that would get you to $150 per share, right? So I want to ask, this year, alongside their earnings, they gave, hey, here's our guidance for fiscal 2024, right? And the midpoint of the guidance is about $5.20 per share in EPS. So right now at 95, they're trading for about $18, 18 PDE, right? So my two questions are like, there's a little bit of, my one question is, there's a little bit of multiple discrepancy there, but I think the big difference between your fair value and where the stock is sitting is, hey, they're guiding for 5 and you think they can do 7, right? So can you kind of walk me through how they get to 7 and like which parts of the thesis are still supporting and intact on that?
Yeah. Well, look, I mean, the midpoint of the guide, I think, is now like 525 for this year. And I think there's lots of conservatism baked into that guide for this year. And I think looking into fiscal 25, I still think we're going to see, this year volume will be choppy. But next year, I think we'll be back to sort of a low single digit growth cadence. Maybe a bit more because we've got more plants coming online, and you presumably aren't going to bring those on without filling at least a decent chunk of that. So I think next year will be, somewhere in the $6.50 to $7 range. And, one hopes that, I think the multiple is compressed today because of, all the fears that we've talked about. And I think if those fears are dispelled next year by, new supply coming online and pricing remaining intact, I think we'll be back to a 20, 24 times PE business. So, if you say rough numbers, $7 at 20 times, you're at 140 in 18 months. So I still think, that the price target over 18 months is still quite valid. The only thing that's really changed here is volumes are choppier than I had hoped this year, and the SG&A guide is higher than I had hoped.
Yep. If we just for next year, right? So not this year, but next year is where they're kind of getting into the mid sixes and stuff. What's the big driver to you? Is it just pure volume, or do you think that it's some? And I wanted to differentiate between price because they are going to get price. But as they said on the call, hey, a lot of the price has been us just passing through or catching up on inflationary price. Like the real price that investors want are the price on top of inflation, right? So is it going to be kind of that profitable pricing growth, or is it just going to be all volumes as kind of the customer drawdown normalizes and maybe we get some better trends with the going out to restaurants and everything?
Yeah, I mean, so the way I model it is I basically just run through the price increases announced to date, and the COGS per pound that I have a view on. And from there, I just assume we hold on to margins. So price and COGS move in concert together. So I'm assuming no pricing power going forward beyond what pricing has been announced so far. But I think there's still upside on COGS because they're basically guiding to mid to high single digit COGS per pound growth this year, right? And the way they get there is they say, well, contracted price for potatoes is up 20, and that's about a third of our cost structure. So there's 6 points right there. But remember, we're coming off two of the worst years in potato crop history. And last year they had to buy a ton of potatoes in the spot market. They had to ship them across the country from Eastern Canada and the East Coast. And I think there's something like 100 to 150 bucks of COGS relief on a normal crop there. So the COGS per pound inflation is going to be, I think, a lot more muted than what the street thinks. And if you talk to the private guys, this upcoming year, the potato costs is the only thing that's really ripping. They sort of expect everything else to be basically flat. So in my view, we're still lapping these residual price hikes. And we will over the next 12 months. The latest price was in May of this year in food service. And we're going to start benefiting from having a normal crop over the next 12 months. So we're still going to get a pretty big chunk of margin expansion this year. On top of that, I think volumes, maybe not this year, but volumes next year, I think will be better, right? Because we've got, they're adding about 8% to their own capacity over the next 2 years. And presumably, half of that should be filled out of the gate. So that's a 4% volume tailwind. And on top of that, we're still running about somewhere between 10 to 15% south of pre-COVID volumes. So if there's some kind of recovery there, we could pick some additional volumes up beyond there. And then I think the last interesting thing here is just Europe. So that's, they're guiding to about $1.1 billion of revenues in Europe over the next 9 months, which is on a run rate basis, basically flat with Q4, what it did in Q4. But the potato crop in Europe over the next 12 months is up 35 to 40%. And this is a much more spot market. And so everybody's eating those costs. So presumably pricing is going to go up 35 to 40% on top of that. So I think that the guide in Europe is really quite conservative as well. So you put all those things together, and I think we're going to be in for a pretty massive beat still this year. And then looking out next year, we've got volume growth, we've got still a bit more additional pricing coming to lap. But I think that the biggest difference is just what's going to happen this year.
Those capacity additions that they're doing, what sort of return on invested capital do they look for when they're doing capacity additions?
I mean, they won't give you a number. They won't give you a number, but as I've done the math on an unlevered basis, it's something like high singles, low doubles. So it's
that was kind of what I would guess in my head. And on an unlevered basis, high singles, low doubles, people are like, oh well, Nvidia does a cajillion percent like high singles, low doubles in a stable business like this, unlevered, where you can, I think they've got a pretty conservative cap structure. But even if you apply 20% debt to it, like you start getting to IRRs that any hedge fund manager you wouldn't be the greatest in the world, but you'd be retiring pretty well if you generated those returns on equity. Let me ask another question. So in reviewing our last podcast, one of the things you talked about was, hey, margins are still well below where they were pre-COVID. And I think there's a lot of room for margins to run. And we actually are seeing some of that, right? You were talking about, if I remember correctly on the last podcast, gross margins approaching 30%. And gross margins this year are approaching 30%. Actually, one analyst came on the call and said, hey, I've got your gross margins for this year around 25%, which looks good. Is that right? And they're like, blah, blah, blah. Wait, did you say 25%? It's not 25%. We don't guide a gross margins, but it's not 25%. And the analyst came on and was like 28%. And the company was kind of like, okay, 28%, that's fine.
Yeah, it was like a record screech stop, right?
It was pretty funny. And I realized people who didn't listen to it or don't listen to calls might be like, what, 25 for you? But it was quite funny. Yeah. But so they are they're approaching that 30% range. So, that looks to me like you are getting the margin part of the story that you talked about, but it's not all falling through to the bottom line. And a large part of that, obviously, is the SG&A investment they're doing. So I just want to talk about the SG&A investment, because I think a skeptic could look and say, hey, okay, the gross margins played out, but the SG&A is there. So either maybe they're pulling stuff out of the gross margin line into the SG&A line, or maybe they need this investment to support it, but we're not seeing that operating leverage. So, it's going to be tough to get to that $7. So just want to ask you about that.
Yeah. No, look, I think the SG&A it's kind of a mystery to me too. I mean, the company will talk about their ERP spend and the IT spend, and how, that's hurt them over the last couple of years, but the end is in sight. But if you go back to 2018 transcripts, they've been talking about ERP since then. And the old guidance for SG&A was 8 to 8.5% of sales, and now they're talking about 10 to 10.5%.
Yep.
And so it's honestly a mystery to me where the spend is going. I don't think it's accounting.
And that's, if this is going to be at 8% of sales, this is a 22% EBITDA business. At 10%, it's a 20%. Like that is literally a 10% difference in earnings right there, right? And it's actually higher on a net income line, because you're going to get leverage going down to the net income line. So
yeah. I mean, I think, and it's also kind of incredible that SG&A bloat has happened at the same time as volumes have been down too, right? So SG&A on a per pound basis is bad. So, and it's kind of a mystery. You wouldn't expect an agricultural adjacent company based in Idaho to be spending money like water, but here we are. So I think, I take them at their word. I bake in the SG&A guide. I assume it remains kind of bad. It's hard to imagine it getting worse from here. But, I think operationally, on pricing, on COGS, as long as the business continues to perform like I hope it will, we'll still be looking at $150 stock in a couple of years.
And last question, and then I think we can wrap this up. But, the company is having an investor day in October. I think this is their first investor day since, I'd have to go check my notes. It's since. So what do you expect them to show at the investor day? Investor days, for those who don't know, if you've got a company that does an investor day every year, it probably nothing really is going to be. But when you've got a company that's never done one, or that does one every 3 or 5 years, a lot of times the investor day is a big catalyst. Like they're going to tell the story. The companies like to reveal new products, new stories, put out long-term guidance at investor days. A lot of times you'll see stocks move 10, 15%, sometimes more on an investor day. So I just want to ask you, what do you expect them to focus on at the investor day? Obviously, you're not going to say, obviously, you can't plan for them to do something that pops the stock 20%, but what do you want them to focus on? Is it explaining the SG&A, new capacity, diving into the French fry rate? What are you looking for?
Yeah, well, first of all, I'll be looking for the French fry bar.
Do they have a French fry? Will they have a French fry bar?
Yeah, I've been pushed. I've suggested it to IR, and he says they're looking into it. So
it's going to be in Manhattan, right? I think they said it's at the New York Stock Exchange.
Yeah.
I might be sending IR a note to see if I can hop on that list, so that you and I can take an Uber over together.
Yeah, let's do it. I'll be there. I'm a little bit gun shy by investor days. I think 9 times out of 10 stocks go down on investor days.
Is that right? I probably would have guessed 2 times out of 10 down, 6 times out of 10 flat, and 5 times out of 10 flat, and 3 times out of 10 up would have been my guess.
Maybe I just invest in bad companies. But
there's no statistical study here. This is completely my gut.
Yeah. I mean, just in my experience, I've seen a lot more stocks go down on investor days than go up. But this is totally anecdotal. So I'm braced for that. And I've also, I've thought about, does it really make sense for them to do an investor day? Because I mean, at its core, this is a really good business, right? A really good industry. And there's a joke, an old joke that, the CEO of a great business lies about how great his business is, and the CEO of a terrible business lies about how terrible his business is.
It's the 0 to 1 thing, right? The Chinese Chinese restaurant down the street says, we don't have any competition. We're the best Chinese stand in the world. And then Google says, we have so much competition. I mean, it is just brutal out here being the only global search engine used by people. It is so hard.
Yeah. So, I mean, I have sort of reservations about that, right? This is a business that has real pricing power. They're the only public company in the space. So do you really want to spotlight how great your business is for all your competitors and customers and all that? But, those are just thoughts that have been running in the back of my mind.
Let's dive. I agree with you, right? Because here's a company, they are 2 times levered. So it's not like they need better access to the capital markets, right? They can easily roll their debt. I actually think they should be a little higher levered. They've got a almost 20 times earnings multiple. So yeah, maybe it should be higher, but it's not like the street is giving them an 8 times multiple. And by the way, if they thought their multiple was too low, they could just take advantage of it and get more aggressive on the repurchase program. I don't really, a company that the market kind of gets their story, no need for capital. I don't know what an investor day is doing for them, to be honest.
I mean, you could say that about 90% of companies.
Yeah.
And you could say that about having, investor relations teams at all, right?
I don't tell the investor relations teams I talk to, but I do say that about investor relations teams.
Yeah, I mean, why does anybody even bother with us? Like, right? You run your business, the stock's going to go where the stock goes, regardless of whether you're talking to investors.
The only ones I really think should do it are ones with complicated accounting stories or like emerging stories, but where they are going to need the markets at some point, right? Because even if you don't need the equity markets, if you need the debt markets and your stock is 2 versus your stock is 200, you're going to get a different interest rate. So you kind of, but for LW, like, I just don't see it. It's not like they need to explain, hey, we've got 500 plants coming on in the next year. We need to help you model this. Like, I don't see it.
Well, I mean, I think, getting back to your original question, I mean, I think the things that would be helpful is just a full picture of global supply and demand, right? And stratified by region, stratified, importantly, by product type, because not all capacity is equal, as they will tell you, right? A lot of the new capacity coming on in Europe is the basic sort of either private label or McDonald's grade shoestring fries, whereas a lot of the Lamb's capacity coming on is specialty and coated. Think, Chick-fil-A waffle fries, and those aren't necessarily going to be competing with each other.
When if I go to the store and I buy like the Popeyes or Arby's brand seasoned frozen fries. Mm-hmm. Does LW put that seasoning on them when they sell the?
They should.
Okay. I'm guessing that's higher margin than when I go to the store and I buy, as you said, the McDonald's non-seasoned fries. Like, you're just getting margin for the seasoning, and obviously some of it's going to the brand that's licensing it, but that's got to be higher margin, right?
Yeah. I mean, the more coated, the more specialty, the higher margin it's going to be.
It's just interesting. This isn't going to blow anyone's mind, but it is just interesting. Like, I do think society, as you get richer and progress, like, you get more and more into specialty and coatings and that type of stuff, and that obviously plays right into longer term margins for them, as is the demand. We all want to eat potatoes. That demand does keep going up. But anyway, anything else on the investor day?
Yeah, well, I mean, I think it'd be great to have a long-term view of global supply and demand. Demand would be really, really interesting, because that nobody publishes that.
They've got plants in China that they're starting up, and I could see if they could provide some data on China. Like, I don't particularly know, but I could see, hey, you guys are really underestimating China and India as they get richer and kind of as their diets get a little bit more Western, how much demand for potatoes there are there, and we're kind of in the driver's seat to provide a lot of that. Yeah.
I mean, that would be extremely interesting. They haven't provided an update on that kind of stuff since the spinoff in their 2016 Investor Day. So I think getting a very very good view on global supply and demand, who's bringing on what supply, where, what kind of capacity is it, and what regions are growing at what rates, would be hugely interesting, and probably go a long way to helping the market feel better about this potential oversupply situation. And especially if they can put numbers on a page, and I've done this, but how much is supply growing relative to demand, and what does that mean for excess capacity? Right? People hear, oh, there are 400 million tons coming online this year and 500 million tons coming on next year. Oh my gosh, these are huge numbers. But if you map it out, nobody knows what the installed base looks like unless you've been obsessed with this company and French fries for a while, like I have. And on my numbers, North American supply is growing at I don't know what it was, like high singles over the next 2 years. Or sorry, no, global supply is growing 10 over the next 3 years, so call it 3 to 3.5% per year, against global demand growing at one hopes 3%. So we were looking at oversupply or excess supply of in the basis points rather than percentage points, and it's hard to imagine that really upsetting global pricing. But it'd be really helpful for them to just put that on a page for people. And I think ultimately, I mean, if they're going to have the investor day, I'd love for them to put out a 3-year EPS target or 5-year EPS target, just to give people some comfort around margins, SG&A, and all that kind of stuff. But I think those are just the two most important pieces.
Last quick question, and then we'll kind of wrap it up. Just share repurchases, right? The stock is here in the high 90s. Obviously, you've got a fair value of, let's just call it around $150 per share. They bought back, I'm looking at their 10K right now, let's be generous and call it a token amount of stock in Q4. Now, the stock was at 110 at the time, but they bought back about $4 million worth. That's really nothing. Do you think the management team will, if the stock lingers around here, kind of, let's call it 2/3 of your fair value, do you think they'll step up to the plate and kind of get aggressive with repurchases?
I mean, I would love that. Obviously, I think they're probably too conservative to do that, especially with the CapEx slate ahead of them over 12 to 24 months. And they're still sort of integrating Lamb Weston Meyer in Europe. So I don't expect them to get more aggressive. I would love that, but wouldn't count on it.
And now, a quick word from our sponsor. Are traditional expert calls in the investment world becoming obsolete? According to Stream, they are, and you can access primary research easily and efficiently through their platform. With Stream, you'll have the right insights at your fingertips to make the best investment decisions. They offer a vast library of over 26,000 expert transcripts powered by AI search technology. Plus, they provide competitive rates on expert call services, and you can even have an experienced buy-side analyst conduct the calls for you. But that's not all. Stream also provides the ability to engage with experts one-on-one and get your calls transcribed free of charge, all for 40% less than you would pay for 20 calls in a traditional expert network model. So if you're looking to optimize your research process and increase ROI on investment research spend, Stream has the solution for you. Head over to their website at streamrg.com to learn more. Thanks for listening, and we'll catch you next time. I'd love to see him get more aggressive with the buybacks. And also, again, I said it earlier, but this business at a little over 2x leverage, it's just not leveraged enough for a steady business like this. Like, I'd love to see him. I think I'm looking at a 2019 earnings release. I think they were closer to 3 in 2019. Yeah, I'd love to see him just take it up a turn, and you could buy back a lot of stock. And I think that all the metrics get a lot more interesting if you do that. And I don't think 3 is like, at 3, it's not like we're talking about, hey, we're running on a knife's edge with our leverage or something, right? So I think that would be fine.
I'm with you. With you.
I know you're with me. I'm just bringing it on its world. Anything else we should be mentioning? I think this was the call we did in December holds up really well. People should go listen to that if they want like the full story. I just wanted to do an update. But anything else on your mind here?
Yeah, well, I think the last thing that I think is pretty interesting is I think people have this fear of over earning, like, oh, this is a cyclical industry. They've taken so much price because supply was artificially suppressed for whatever reason, and now supply is coming back. So we're going to give everything back. If you actually do the math, and this is really interesting, margins aren't all that much higher versus pre-COVID.
No. So that's what we were talking about. No.
Yeah. So in 2019, pre-COVID, The global business was a 22.8% gross margin. And on a like-for-like basis, it's probably like 23 they just reported. And then, so some marginal increase. In food service, they were doing 35. They're now doing 37.
And by the way, they took SG&A way up, so it's not like on a bottom line basis they're making a lot more.
Yeah. And the only segment where they really had massive improvement was in retail, and that went from 20% gross margin to 35. But there's also a mix shift in there, going from private label to a lot more branded product. It's impossible to tease out how much of that was price, how much of that was mix. But that's probably the segment that's most susceptible to price competition, especially because that's where you're going to be competing with the European guys that are bringing on capacity. But what I think is really interesting, if you say, okay, they are over earning, we're going to revert to pre-COVID margins, which again, we're still good. They're all-time highs. But the trajectory of the business was up and to the right up until that point. But if you revert to those margins on fiscal 25 numbers, I'm still basically at 520, right? And at that point, if we've dispelled the over earning fears and we get a historical multiple in the low 20s, you're still at 110 to 120. So if this industry does at least revert to 2019 pre-COVID margins, it's hard to lose money. You're still probably making money. And the only way you really get destroyed is if this industry completely unravels. And nobody in the space is saying that's going to happen.
Right? You need the ultimate bear case, which is Andrew and 5 million of his best friends stop eating potatoes, right? So you need the potato demand.
Not only stop eating, but open 500 new plants.
I was saying potato demand, because you mentioned global supply is going up kind of 3% annually. So you need global demand goes down 2% annually while that supply is going up 3%. Like there's your bear case. But again, I think just the history of consuming, I guess, what the other bear case is that we haven't mentioned? GLP-1. This would be a good, if 15% of the American population starts taking GLP-1, because, everyone, I don't know that I know of. I don't know anyone on GLP-1, but I've looked at it. And when you start taking it, I'm hearing doctors need to prescribe protein shakes to people because they lose their interest in eating so much that they're not eating anything. GLP-1 would be a great bear thesis. Hey, 10% of Americans are going to be on GLP-1. They're not going to be eating. They're going to eat 500 calories per day. There's your demand of destruction.
Yeah. I mean, I think it's, I don't have a great answer for that still. I mean, I've looked at it. I don't know if anybody knows exactly what the impact is going to be, but, you can look at the stocks of Krispy Kreme and Domino's and Mondelez and, Hershey, and like, they're all doing fine year to date. Yep. I mean, so I don't think, as far as impacting the stock to date, I don't think it has. But the market's looking at guys that are much more directly exposed, and
completely agree
so far.
And like a potato, we think French fries, but it is a lot of potato processing. So they've got other stuff. And yeah, I just think, like, as you said, a Hershey's or a Krispy Kreme are the ones where I really think that GLP-1 are in the targets, and you're not seeing any fear there, but it is an interesting bear case.
Yeah. But ultimately, I think the impact, I would like to think it would be pretty manageable, because you're talking about, a fraction of the American population going on this thing, which, from Lamb Weston's perspective, you've only got X% of your business in the US, and then X% of your customers would go on GLP-1. And of those X%, they would reduce their consumption by Y%. So I think, we'd be talking about a fraction of a fraction of a fraction in terms of impact to the business. But, it's still,
I would be very, very skeptical of a GLP-1 thesis, but I do think, like, if you're talking 10% of Americans go on GLP-1 and they reduce their consumption by, I think 50% would actually be generous versus what people are actually doing. Like 10% and 50%, that starts to move the needle. Though there is going to be the counter, like, once you start reducing calories, I think people are going to be looking for, they're going to be looking for an upgrade in calories. So I think they look for less, like, I could see a shift from breads or junk foods to more like wholer foods. And I know people think chickens and beefs when they think that, but I could see a shift. Hey, like, what are people's favorite foods? Generally potato based. I could see a shift towards if I'm going to eat something, even though I don't want to, I might as well have it be a potato or something versus a sandwich that I think is kind of nasty.
Yeah, I mean, we're like way off in the land of speculation.
Yeah. It was just sometimes you chat. Cool. Well, AJ, look, let's wrap it up there. And I will say thank you for coming on for the second time. I really enjoyed it. It's a really interesting company, a great company. But what I'm really looking forward to is I know you're working on another big one, and I'm hoping in September or October, when you're ready to talk about it, we can have you back on. I'm really excited for that as well.
Yeah, that'd be awesome. That'd be great.
Cool. All right. Talk to you soon, buddy.
All right. Thanks, Andrew. See ya.
A quick disclaimer, nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.